Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, July 16th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro events are debating the durability of the Trump trade. In terms of market implications, the sharp slowdown in the Eurozone ZOO expectations index in July indicates our green shoots globally theme continues to unravel. The June retail sales and July New York Fed services sector activity data indicate the preponderance of evidence continues to support our view that the U.S. economy is slowing and likely to continue slowing over the medium term. That our core risk management signals have yet to endorse the Trump trade is telling in this regard. Investors should proceed with caution until they do, and they may not, as the political cycle rarely overwhelms the business cycle in dictating the market regime. Anything can happen, but we are not in the business of positioning for anything. We are in the business of positioning for the highest probability outcomes. Transitioning to our 42 macro dashboard. As always, a wrap up here with a question from our community. This one's regarding a surprise surprise cut in July and its impact on markets. So the question reads, "Hi Darius, as you've mentioned, money markets do not agree with the July cut. Should the Fed make a surprise cut, what effect on asset markets would you likely expect?" So the question, the two answers there. So we've not been arguing that the Fed should make a surprise cut. We were arguing that the Fed has the green light to cut in July. I don't believe that they will make a surprise cut because the J. Powell Fed has historically eschewed surprising asset markets either to the hawkish or bearish side. So just be aware of that. They've been very big on using the forward guidance function to condition markets for their behavior in terms of setting policy. But the thing I will say is that we do have another, let's call it week and a half or so between now and the blackout period. And so investors need to be aware of that, that Jay Powell and other Fed officials may be sent out of the equities building or out of their respective regional banks to regional Fed banks to cool like doves in the coming, let's call it 10 days or so, and it could potentially condition markets for a July cut. It seems unlikely at this point, just given the lack of movement we've seen in that direction since we got the ultra dovish CPI report last Thursday. But it may be the case that they can, so they could. And all we're trying to argue is that they are very much likely that they very much have the green light to cut. And so in terms of if they were to cut and it would be a surprise, it'd be somewhat of a risk to the downside in the sense that the investors might interpret that as a signal that the Fed is concerned about something that the broader investor community cannot see. That's usually not the case, but I will say that typically speaking, when the Fed starts cutting rates, it historically has not been a bullish leading indicator for the economy or asset markets. This time may be different in the sense that we do have conditions in place that could potentially create a soft landing scenario. However, we don't want to make a hard determination on that at this particular juncture. I think the most important thing investors need to be focused on is the slowdown in nominal and real growth, when that slowdown is likely to kind of reach its nadir, and how the leading indicators of a recession could potentially be aligned once we get towards that nadir in 2 to 3 quarters. So just be aware of that. We'll be now casting that whole entire process along the way. And the final thing I'll say is that obviously, if you are watching me talk, you're probably not, among the elite of the elite in terms of global investing. And I think if you're not among the elite of the elite in global investing, I think the most important thing investors probably should have learned over the last 2 years is that predicting recessions is a fool's errand. It's very hard to predict a non-stationary event, a non-linear, non-stationary event. So clearly, I think the most important thing we've learned from that exercise here at 42 Macro is the value of now casting. I mean, we already knew that. That's something I've been doing in my career for a really long time. But in the context of trying to identify where you are in the business cycle, having built really powerful and durable tools to sort of help us identify exactly where we are in the business cycle, what indicators are leading, what indicators are lagging, what the leading indicators are saying, whether those lagging indicators are confirming that, and ultimately we're using that information to identify critical inflection points in the economy, which ultimately lead to critical inflection points in the market. So definitely come check that out if you have not seen that analysis. So we're wrapping up there. Darius presenting our macro minute for Tuesday, July 16th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow.